Yeah. In this session, let's focus on the future markets and contracts, which are more or less similar to that of forward markets to a large extent, but with a couple of minor differences as we have understood earlier itself. One, the future markets or future transactions generally happen on organized exchanges, whereas the forwards are mostly over the counter and more of negotiated, customized kind of transactions. And in the futures market, we talk about scenarios of margins and even the concept of mark to market, where the settlements generally happen on a daily basis, whereas in case of forward market, the settlements generally are at the end of the contract period. Except for these two or three differences, we see that there are not too much of differences existing between the forward and the future markets. So, as far as the calculations are concerned, or as far as the key aspects are concerned, whatever are applicable to the forwards, finding the value or finding the price, whatever are applicable to the forwards, by default they are applicable to the futures also. And wherever there are differences existing between these two markets, we are dealing with those differences specifically in this session. A few things to remember. On the expiration date of the futures contract, whatever is the date, on the maturity date, we observe that the futures price should converge with the spot price. Why? Let's assume that the expiration date of a futures contract is 20th December 13, and today the date is 20th December 13. What is the spot price of any of that asset? Let's say we are talking about the underlying asset as copper, any metal. Now, the spot price of the asset, spot price of copper is the date for the delivery of copper, or the price for delivering copper on 20th December 13. And at the same time, when I am talking about futures price, which is expiring on 20th December 13, this is also the price for delivery of copper on 20th December 13. If the today's date is probably 19th or 18th December, the delivery price for 20th, which is the futures price, maybe the is different from the delivery price for 18th, which is the spot price. Whereas when it is the same date, the delivery price, whether it is in the spot market or in the futures market, should be the same. So if when that is the scenario, the futures price should be same as the spot price on the expiration date. If at all these two markets there is a difference in the price, then arbitrage will be present. So probably if the futures price is greater than the spot market price, there will be heavy buyings that will happen in the spot price on that day, spot market on that day, and heavy sellings happening in the futures market. So because of heavy buyings here, the price will increase here, heavy sellings, the price will decrease, and again they will increase and decrease in such a way that both of them are going equal on that day. So by default, we can very safely assume that on the expiration date, the futures price will be equivalent to the spot price. That is what we mean by the statement, futures price and the spot price converge at the expiration date. Alright, that's one major concept we have to be comfortable with. Then, when we are talking about the value of the futures contract, in the forward contract, if we remember, at any point when we were talking about the value, we were talking about the spot price minus the present value of the forward price. This was what was the typical definition we were giving to the value for the long position. Now, if I have to apply the same concept to the futures, what I would see is this forward price, in this case probably the futures price. This futures price is reset on a daily basis because of mark to market. Right? The futures price is reset on a daily basis because of the mark to market, which means, and this is reset to whatever is the updated settlement price. This is reset to a settlement price and a new contract is opened for the next day. What does that mean? This price keeps changing on a daily basis, and once there is an update, these two values become the same, which means the value will become zero immediately after the day-to-day settlement. So that is what I meant by this statement. The value of the futures contract is zero after the adjustment to the mark-to-market losses and profits. Probably after my margin account is updated with the loss or the profit based on the mark-to-market settlement price. There is no outstanding loss or gain to any party at that point. Between two mark-to-markets, so today's settlement price and tomorrow's settlement, in between there is a difference between this, which is nothing but whatever is the spot price minus the present value of the previous mark-to-market price rather than the futures price, previous mark-to-market price. So whatever may be the loss that can exist in a futures market, the loss or the credit risk is generally limited to a single day's loss, because at the end of the day it is already mark-to-market and the accounts have been updated accordingly, so there is no pending loss or pending gain to a particular party at the end of the settlement period. So which means the possibility of credit risk is much lower compared to that of a forward market. So anytime you are getting into the pricing, we are looking at whatever is the new contract that is getting created after the settlement of the mark-to-market gains or losses, whatever is the new mark-to-market price, based on that particular price we are setting the futures price. So the spot is getting updated as on a daily basis into 1 plus r to the power t. The formula still remains the same, but this number keeps changing on a day-to-day basis, and based on this is what we are arriving at the futures price. And as I have already highlighted, between the two mark-to-market dates are probably times. During the day, intraday, the contract value is just calculated similar to that of a forward contract, which is nothing but the spot price minus the present value of the previous mark-to-market price. So that is one other key difference that we observe between a futures contract as well as versus a forward contract. Then another key thing to remember as a contrast between these two: when will people prefer futures over forwards, or when are futures more attractive